Let's see. This should be interesting. Here we go.
All right, let's get right into it. For way too long, being a liquidity provider in DeFi has felt, well, like a total gamble, right? You put your tokens in, you cross your fingers, and more often than not, you just get wrecked. Today, that stops. We are going to break down the actual math to turn this thing from a wild guess into a calculated business where you can actually have a positive expected value. First things first, we have to completely destroy this one idea. If you're still thinking of LPing as passive income, you are starting from a very, very dangerous place. That whole idea, it's pretty much dead. The game has changed. As the experts say, you're not a passive farmer anymore. You are now an active underwriter of risk. You know what that means? It means you're basically an insurance company, and you're selling insurance against price moves. Once you get that in your head, everything else starts to make sense. And just like any insurance business, you have a main cost. For you, that cost is impermanent loss. And let's be clear, this isn't some weird, abstract crypto thing. It's the real money you lose when a price swing goes against you. It's the cost of doing business. This is the dragon you have to slay. Okay, so if you're taking on all this risk and you're paying this very real cost, how in the world do you actually come out on top? How do you make sure your little insurance business is profitable? Well, it all comes down to the numbers. To do that, we need to break this whole problem down into three key parts. Think of these as the main variables in your profit equation. If you can get a handle on these three, you're most of the way there. First up, implied volatility. This is your number one cost. And the best way to think about it is as a volatility tax. Seriously, the wilder the market expects the price to swing, the higher the tax you're going to pay in the form of impermanent loss. Now for part two, let's put it all together with the break-even formula. This is how you figure out if a position is actually worth taking. And here it is. It looks so simple, right? But it is so, so powerful. Your real profit is the fees you earn minus your gas costs minus your impermanent loss. If you're looking at some APR that doesn't account for IL, you're just fooling yourself. This is the only equation a pro LP cares about. And right there, that's it. That's the whole decision. Your math says you need 50% just to not lose money. The market is only offering 20%. This is a negative expected value trade. It is a losing proposition.
And so what I would submit to you guys is that most pools are negative expected value. I think probably the vast majority are.
From the start. You do not enter this pool, period. So let's boil this whole thing down to its simplest form. Part 3, the go/no-go decision. This is the simple framework that you can apply to every single LP decision you ever make. Here it is, your decision matrix. It's always a fight between the fees you're earning and the volatility you're facing. If the fee APR is higher than the expected cost of volatility, that's a plus EV trade. That is a go. You take that trade. But if the fees are lower than what you expect to pay in volatility tax, that's a minus EV trade. That is a no-go. It's really that simple. And that's really what it's all about. That's what separates the amateurs from the pros. Amateurs see a high APR, get greedy, and just hope for the best. They're relying on luck. Professionals, they have a process. They understand that even a good process can lead to a bad outcome sometimes, but over the long haul, a solid math-based system is the only thing that works. Because in this game, process always, always dominates luck.
That's right. Very professional.
All right, let's get right into it.
Okay. So what did you guys think about that? I think that the gold here is right here at the end of it. This, where is it? So that's the go, no go decision. It's this.